Good evening, everybody. Thanks very much for joining. This week, I want to look at how we can use technical analysis for in-flight trading. And by in-flight trading, we mean in reaction to markets that are already moving through data release or from a headline, where we can use technicals to actually decide whether or not the move is becoming significant, and we want to try and take advantage of that short-term volatility via the data or headline that's just been released. So how can we approach this type of information? Well, I'm going to look at the price of gold and the reaction that we saw to the US CPI data on November the 10th. And it was a very well-publicized data point, a very significant potential sentiment driver for markets, and really was likely to see significant moves materializing once the release was seen. So how can we use technical analysis to try and prepare for such a data point, and how we can anticipate the potential reactions to that data and what we want to see in terms of price action? Well, often when we have such a significant data release, such as the CPI data was at that time, the market will enter a consolidation period. And this is a 15-minute chart of gold on the 10th of November in the run-up to the data release. And you can see that often in this type of environment, the market will go quiet. It will see a lack of volatility, a lack of trading, as we basically prepare for the data release, and then we can digest the new information. Well, from a technical perspective, how I like to approach this is to use this period of lower volatility to prepare in terms of what I anticipate for price activity, where the significant support and resistance levels are, and the types of signals that I would need to be seen generated to mean that I want to take advantage of this new volatility that's developing within the market. So the template that I use is a very simple one. I tend to look at something that measures volatility. And for me, the best indicator to use for that is Bollinger Bands. And you can see that in the run-up to the data release, the bands were parallel, the mid-average was flat, highlighting the lack of volatility and the sideways trading move that was beginning to develop. I then also like to have a momentum indicator and a trending indicator. So I would use something like the slow stochastics to give me the momentum measure, and the MACD to highlight the trending condition of the market. And again, as we ran into this 15-minute chart, you can see that the MACD was flat around the zero line, really highlighting a lack of trending conditions within the market. Okay, so we know when the data is going to be released. We know that the market is actually consolidating into that new information. So this allows us to prepare for the types of movements that we can see generated once the data comes out. Now, the information release was lower than expectations. That meant a weaker dollar and a higher price for gold. And this was the initial reaction within the first 15 minutes of trading once we started to see the data release. But how can we use technicals and this template that we're looking at to actually anticipate this type of move? And once we see the data, whether or not we're seeing a more significant price action beginning to materialize that we can take advantage of and look to trade. So we're looking at the 15-minute chart here. What I would tend to look at before the data release is some longer term charts. So a 4-hourly chart, a daily chart, to highlight where the significant developments are occurring, where the important support and resistance levels are, and whether or not, once we start to see those points broken, we want to actually trade once we see this new information and the initial reaction to it. So as I say, I would look at a 4-hourly chart. So again, this is the period where we saw the data release, but in the run-up to that, we're able to look at price action to get a feel and a gauge for where directional risks are beginning to develop. And if we start to see more positive themes, i.e. looking for a higher price in gold, whether or not a lower reading on the inflation data would trigger the types of movements that we're looking for. So if we look at the 4-hourly chart of gold from a technical perspective, in the run-up to the data, and this was the data release here, as we can all see, but importantly, price action was already above the rising Bollinger Mid average. So we were already trading within a positive trend. Now, we may not want to wait, or we may want to wait for that data release before we actually activate a new trade to take advantage of this positive trading, because we know that if an unexpected high number comes out, then the market is likely to sell off. So we need to see that data. But because we're trading within a 4-hourly positive trend, we're above the rising mid average, the MACD is above zero and above its moving average, and momentum's rising, we know that we're trading in a more positive theme. So a weaker number, or a weaker lower headline number, would likely trigger further upside and be a more positive slant for the price of gold. We've also, pre-data release, broken above the downtrend, connecting the recent highs within the 4-hourly chart. And the consolidation that we were seeing into the data release was nothing more than a normal pullback towards to test what was the old resistance line, which then becomes support. So we know that we're back towards the support in a positive trend. So again, the information is that, again, if it's a weaker number in terms of the data release, that may well be more constructive, and we would like to play that particular trade within these positive themes. We can then look ahead of the release, looking at the daily chart to see if there's any more significant resistance levels or support points that are evident and where the activity is beginning to pan out. Well, the daily chart showed us, or this was the day of release again, that we were trading within a more positive daily trending condition. We'd broken above a longer term daily trend resistance point. And that the fact that once we started to see the daily release, we were tagging the upper band within a positive band, and the daily Bollinger Bands themselves were already widening. So we were looking at a more constructive trending condition with increasing volatility, even ahead of the number, to suggest that any data point that saw fresh upside materializing perhaps would have more significant implications for price strength, and that we can take advantage of that new information and that increasing volatility. So if we move back to the 15-minute chart for gold, and again, this was the data release, we can see the information that was actually occurring once we start to see the reaction to that lower data. So again, we've already prepared for the potential of positive price action. We know that the 4-hourly chart, we know that the daily chart are more constructive, and they're continuing to see risks of upside. But we need to see the daily point, the data point, to actually trigger that need to trade and to look for further acceleration within price movement. So within price action, once the data is released and prices react in a positive way to that new information, we're already prepared for a more positive slant for price action. The 15-minute Bollinger Bands are also now widening in a much more constructive way. So even though the market has rallied sharply, we can be fairly confident that we're still looking at more positive potential beginning to materialize within price action, and that the risk is that this increasing volatility can continue and that further strength is potentially on the cards for us to trade, even though the market has rallied a reasonable amount already. We can also look at the 15-minute MACD being above zero and above its moving average, the momentum continuing to rise. The technical interpretation before the data release and during the reaction to it was more constructive. So we would have more confidence in reacting to actually go long of gold, having seen this data release and the in-flight trading reacting to that new information, looking for a more sustained move higher. Now, how long would we hold this trade? Well, we're looking perhaps for a smash and grab trade. So we would look for a reasonably quick profit potential, having seen the acceleration. So it would either be once the Bollinger Bands start to contract once more, that the risk is that we're looking for a more extended consolidation to develop, or when price action starts to break below the rising mid-average of Bollinger Bands to suggest again that that consolidation can develop. So we go into the trade on a relatively short-term perspective, knowing that we're looking to try and take advantage quickly of this increasing volatility and further price strength that's developing within price activity. And once that information starts to reduce, i.e. the volatility starts to decrease, the bands contract, or we start to see prices breaking below the support of the rising mid-average, that we then look for a more consolidation, and we want to step aside and actually see then what happens to price activity. So just to summarize the in-flight trading technical checklist. Now, what may have happened is that you may have been short of gold coming into the data and that you were holding that position over the release. So if you were stopped on the initial trade, the initial reaction to that new data, then your mindset is going to be completely different from if you were initiating a new trade. So to actually reverse from going short to long may be a lot harder than if you were flat coming into that new release, prepared with the information that we've already looked at. So the question to always ask yourself, if you've been reversed or if you've been stopped and you're thinking about reversing, has anything changed within the technical picture that means that I, having been short, now need to go long? Or if I've been flat and I've been preparing for this data release, whether or not I need to initiate a new trade. Well, the important point then comes to the homework, if you like, of what we do with the 4 hourly and daily charts. Have any significant levels given way on that time frame chart? Well, we knew with the gold chart that on both those time frames, important resistance levels had given way. Are there any more significant support and resistance levels within the longer term chart, areas where we can expect the acceleration either to the up or to the downside to be held by support or resistance? Are the indicators backing up the new move? And this is important because obviously, has anything changed within the technical picture to mean that indicators having been negative or neutral are now turning positive to suggest there's more significant upside moves likely within that initial reaction within the price of gold? But then also remember the time frame that you're taking the position in. So in other words, if you're looking at a 15-minute chart, you're looking at a shorter term perspective. Try not to get married to the view that then suddenly becomes a long-term trade if the reasons why you took that initial trade was a sudden increase in volatility, looking for a smash and grab trade on that sharp acceleration move. You can always re-enter the position if you close your original trade out. So don't worry about missing the opportunities within the market. You can always re-enter and react to new signals that may well be generated. And if the indicators start to change, then you need to react to that much more quickly by either closing the position or reassessing the position. And by that, I particularly mean if we start to see Bollinger Bands having been widening aggressively to reflect increasing volatility, if the bands then start to contract to highlighting an easing in that volatility, and that means that the market could be going into consolidation. So it's important to actually be prepared for this important information that something like the last CPI data offers us in terms of important sentiment drivers and significant increases in potential of volatility that we can take advantage of. But by being prepared, you know the types of signals that you're looking for, you know the type of data that you're looking for, and the likely market reactions once you see that data, and whether or not it's likely to materialize and develop into something more significant.